Hi, everyone, and welcome to this quarterly review of the air taxi companies listed on the US stock markets. Let's look at the price performance over the first quarter of this year. Beside vertical airspace and ehang, all the other stocks underperformed the overall market, represented here by a S&P 500 ETF and the small caps represented by a Russell 2000 ETF. So all the stocks also underperformed the aerospace and defense sector, represented here by XAR. Vertical Airspace had its majority owner injecting cash into the company, so that somewhat helped, but it's also a stock that trades close to the $1 mark and can be extremely volatile. Ehang is the only revenue generating company and has seen a substantial increase in its price from a low of around $9.50 in February the 5th to over $20 on the last trading day of Q1. So a very, very strong performance. I always ask myself if these air taxi stocks are really worth an investment. So I looked up their performance since ehang went public in 2019, and here's the verdict. The S&P 500 would have made you wealthier and I bet less stressed out than any of these stocks. This chart by itself speaks volumes about the state of the air taxi stocks. You don't need to look any further. No company would have turned a profit for you. Even the 6% increase by ehang is wiped out if we look at the real return when inflation is taken into account. Joby, Archer, and Eve would have halved your investment, and lithium and vertical airspace did not even show up on the scale. Reasons like the lack of short term revenue generation, a sector that's capital intensive and highly regulated, schedule uncertainties, and unrealistic entry into service dates, shareholder dilutions, lack of ground infrastructure, and a fair amount of wishful thinking all have contributed, in my opinion, to this dismal performance. Despite what many people think, I believe there is some level of wisdom in the stock market. This is a good chart to keep things into perspective. Let's get into some details here, and this is what we are going to be looking at: stock charts, valuation metrics, short interest, insider activity and ownership structure, shareholder dilution, and cash position. Let's start with the charts. Archer is in a downtrend. Ehang broke out from its downtrend and moved above the main moving averages on nice volume. It's facing the $22 resistance level now, and it may well take a breather between $20 and $24 if nothing major happens. So Ehang back on an uptrend. Eve is continuing its downtrend. Vertical airspace moved above the main moving averages and above the $1 level, but it still has a long way to go. I'm not going to dwell on hover. I'm still very soon to see any direction from the charts. Joby continuing its downtrend just like Archer. Now, these two companies will end up going in different directions depending on which one gets to market first. Archer and Joby have diverging go to market strategies. Not that it is going to be a winner takes all situation, but the winning approach may well mean the opposite one will have some hard time in front of it. Only time will tell. Lilium is trading horizontally around $1. We will see how it breaks out from the pattern shown on the right chart. We have a new addition to the list here, XTIA Aerospace, who is developing the Trifan 600 VTOL business jet. This is not an electric VTOL. The company itself is not new. They've been around for quite some time now, and they merged with an obscure penny stock company called Inpiction to list on the NASDAQ. By penny stock, I really mean penny stock. I mean, they were trading for a few cents, and they had to do a 100-for-1 reverse split prior to the merger with XTI as part of the deal, and also to comply with NASDAQ rules. And that did not prevent the newly listed company price to crash from $6 to less than $2 in 10 trading days. Tough market, isn't it? Anyways, we wish them all the best, and we'll be covering them as they build some track record on the stock market. So overall, a mixed bag for this Q1, with ehang logging a strong performance and the main other players in a downtrend. Let's look at some valuation metrics now. Price to tangible books. Data is from Charles Schwab. The small dot to the left of Archer is hover. EVTL, vertical airspace, does not have any data available since they have a negative shareholder equity. And if we pause here, ehang better have a great reason to explain this gap in valuation compared to the other players. I hear people say that they have a type certificate, that they generate revenue, they are first at this, first at that. But the stock market is a discounting mechanism. So all available information is reflected in the price, including the prices of Eve, Lilium, Archer, Joby, which have a relatively close price to tangible book metric. So the outlier here is ehang. Let's look at another valuation metric, enterprise value over firm orders value. So again, the enterprise value data is from Charles Schwab. Firm orders in number of units are from SMG Consulting. Neither Eve or Hover have firm orders, so we won't see them in this chart. We'll see them in the next one, which has all the orders. No data for Joby since it does not intend to sell its aircraft, so they're not on this chart and won't be on the next one either. For ehang, they do not have firm orders, but they have deliveries. So I used the 214 aircraft delivered as a proxy. Observation, ehang is still largely overvalued compared to the other companies. Now, enterprise value over all order value. Same observation regarding ehang. It is still largely overvalued compared to the other companies. Let's look at the short interest now. Decreasing for ehang and starting to decrease for Lilium. Joby remains quite stable. But Archer saw a sudden increase. I don't know if it is a glitch in the data. We'll see that next quarter, since short interest data seems to be volatile for some reason. If you have a reliable source for short interest data, let me know in the comment section, please. Trends are correlated by the short interest in percentage. Let's look at the ownership structure here. So, some clear outliers. Eve is owned by Embraer, and you can feel it from the chart. It's still a mystery to me why they listed this subsidiary to keep it owned this way. Same thing for Vertical Aerospace. It is still owned at 70% by its founder. XTIA insiders dumped their shares on the general public. No wonder why the stock price crashed. The highest institutional ownership is in Archer and Joby, and individual investors are at risk in XTIA, Lilium, and ehang. Well, let's zoom on vertical aerospace here. So, if you guys remember this huge volume on December 28th, with close to 6 million shares dumped in one day, which I said was a liquidation event. Now, new data is available, and I have an answer for that mysterious liquidation. One institution, Invesco, and one individual who was the former chairman of Vertical Aerospace dumped their shares, with the main liquidation happening December 28th. This is less catastrophic than if American Airlines would have sold its shares, but not having Invesco anymore is certainly not a good signal to send to savvy investors. You can also see that the founder picked up 4 million shares, maybe in an effort to support the price. You can literally make an investment or divestment decision based on this type of information, folks. Let's look now at the shareholders' dilution. And Lilium remains the king of dilution with almost a 33% growth in the outstanding shares. So no wonder why their stock price is still in the $1 vicinity, followed by Archer at 26%. This tells you why some stocks have not made it back to the $10 par value of their SPAC merger. They're still aggressively raising capital by issuing mixed securities like shares and warrants. Something to consider when looking at these startups. Let's look at the cash position of these companies at the end of year 2023. Cash is king, as the saying goes, and when you are in such a capital intensive sector, cash will seal the fate of many of these companies. Joby has the strongest cash position, followed by Archer. But remember, Joby needs a lot more cash since they are vertically integrated. Lilium had $90 million, dollars, but they insist on mentioning $198 million liquidity. In either case, that will not be enough to fund their ambitions since they expect a cash burn of $195 million in H1 2024. Lilium is in a bad spot, and keep in mind that the general public owns almost 46% of the stock. So if Lilium continues to raise cash by diluting shareholders and at a stock price of $1, the individual investors will get crushed and left holding the bag. And pre-delivery payments will not kick in for Lilium before their first flight, so not before the end of this year if all goes well. So they have a valley of debt in front of them. Same thing for vertical airspace, except that the general public holds only 23% of the outstanding shares. Ehang had $45 million. Dollars. They are starting to deliver and will get to mass production sometime soon, which will help with cash. But if they go after the VT30 development aimed at competing against Archer and Joby, then the $45 million will be a drop in the bucket, and they will need to be creative to raise more cash, preferably without diluting existing shareholders. If anything, they should learn from the ongoing struggles of vertical airspace and lithium. That's it for this quarter, guys. Stay out of trouble and see you in early July.